Okay, Colin Andrews, Egbert, realestateinvestor.com. What I would like to do is go over, and this is a continuation of our article, which is Investing in Foreclosures, Why Do Short Sales? And what I'm going to do right now is the 3 different ways that you can be able to profit by having homes or finding sellers that are in pre-foreclosure. Now, not all of these involve doing a short sale, so I want to make sure that that's clear, and we'll go through that a little bit more. The first one is, and I'll go reading back to the article that I have, oftentimes the seller is willing to sell the property at below market value because they'll see that it's to their advantage to cut their losses and move on instead of trying to sell a property that they've already lost so much on. If the seller has enough equity left in the home, oftentimes a purchase can be structured whereby they receive cash at closing, the balance of the equity in payments, or a balloon payment that will be due at a later time. See, when you have equity in the house, and when you find someone that has equity in the house, the options grow a lot. And the reason why is because there's multiple ways. This means that you don't need to necessarily work with the bank if they're behind in payments, that you can, in fact, just go and purchase the property outright without needing to do a foreclosure. If this is the case, and they have enough equity, then you can just get your own financing or hard money if perhaps it needs rehab or whatnot, that you can be able to do that, get involved, and be able to make some money and be able to buy the property and help the sellers out. So that's the first way if these folks are distressed. This is often a good option if sellers have enough equity. Unfortunately, oftentimes today's sellers owe almost as much as the property is worth at the time the foreclosure process is underway. In addition, if you take into account cost of acquisition, sales holding costs, and repairs, the investor can't make a profit because there isn't enough equity in the property for them to do so. So a lot of times there just won't be that equity in the deal, especially because 2-3 years ago, everyone and their mama refinanced, and because of that, they pulled out all their equity because they got money right then and there for being able to do so. So that's one of the ways, though. The next way that you can be able to make money is you can take over the loan and make up the bad payments. When someone is in foreclosure, you can often buy the house from the seller, take over the loan, and make up the original homeowner's back payments. This is advantageous to the seller because the foreclosure is stopped and the investor will take over the payments. However, the seller is at a disadvantage because the loan remains in their name until the investor pays it off at a later date. Now, this can be formatted into what's called a land contract, or also buying the property subject to the existing financing. In a land contract, what normally happens is the person who is writing the land contract, or the seller, does a land contract whereby the buyer, or in this case the investor, would make a payment to the homeowner. The homeowner would then pay the mortgage company. Now, if you buy a home subject to, what normally happens is that the investor directly takes the property either into what's called a land trust or into their LLC. Hopefully they're not putting it into their name, because that's a stupid idea to be holding property in sole proprietorship or in your own name, in my belief. And if that's the case, then if the property is taken over, then those payments will go directly from the investor to the bank. And that's a whole nother lesson in itself, but that is one of the ways, and that is called subject to the existing mortgage. In case you want to read up more about it, just go ahead and Google that. If you buy a home and you take over a loan in another person's name, this is referred to, as I said, subject to. With this type of transaction, the property's title transfers to the new owner, but the loan remains in the original seller's name. Oftentimes, lending institutions don't like to buy properties with the subject to qualification, and they include a due on sale clause stating that the lender can call the loan, and it says they may call the loan due. Not that they will, but they can call the loan due upon transfer of title. Although this is a danger in theory, in practice, lenders don't usually enforce this clause. Instead, they're usually more interested in receiving timely payments than they are in calling a loan due. This type of arrangement does have its risks. because the loan remains in the seller's name, and if the payments are not made, their credit can and will be affected just as if it was originally. However, it benefits the investor because the investor can acquire the property with little money out of pocket and without loan costs or appraisal fees. In addition, their own credit is not put at risk or affected by the loan they take subject to. This is a particularly powerful strategy of investment that most investors don't know about, but ethical individuals should certainly feel free to use it. As with many powerful tools, it can be used for good or for bad, depending on the individual in question. If you purchase a subject to property, you have to sign documents that will inform and protect everyone involved. And so that's a little bit more about subject to. Again, it's something that you have to explain the risks to the seller. If they ask, hey, what happens if you don't make payments? You have to be honest with them. You have to let them know their credit will be affected. If they say, does this mean that my mortgage is paid off? The answer is absolutely no. It is not paid off. They do need to know that, but as I said in the article, that there is some great advantages to both them and to the investor for doing so. A lot of times these the sellers have zero equity and they have no other choice except for being able to sell a property subject to, because if they wanted to sell it outright, they'd have to bring $10, $15, $20, $30,000 to the table. So in those ways and those reasons, sometimes subject to is the best option for the seller. And so the next part, which is actually commonly referred to as a short sale, is that you can discount the loan from the lenders. And this again is if the property normally has to be at least 90 days or 3 months behind before the banks are willing to do this. So this is commonly referred to as a short sale, and is nothing more than a negotiation with the lenders that they accept an amount less than what they are owed. Although this would seem unlikely to be accepted by lenders at first glance, in fact, it's to their advantage at times for a couple of reasons. One, lenders do not want to own property. Banks are not in the real estate business. They do not want to own property. And if a borrower does not pay a loan, the property is foreclosed upon. Subsequently, if the property is not bought at public auction, the lender becomes the new owner. Because lenders are in the business of loaning money, such a situation is to their disadvantage because it becomes a non-performing asset and affects their lending ratios. In addition, because they owned the property, the bank becomes responsible for property taxes, association fees, insurance, realtor fees, etc. 2. Many lenders consider cash now better than cash later. Oftentimes, a bank prefers accepting a discount with a certain payment instead of holding on to something that could end up costing even more costly in the future. Banks often understand that the discounted offer today will probably net them more than a higher offer at a later date when you take in all the consideration of the other fees, including closing costs, realtor fees, or the negatively affected lending ratios. And that's a very important part. There's a reason why these investors are doing it. They're not doing it because they're the Red Cross, because they're not. They're banks. Their whole reason is to go and make money. And the reason why they're doing it and doing a short sale is not to help you out or to be able to provide more deals for you and your family. And it's also not for the seller or for the homeowner. It's because it makes financial sense for them to do so. Whether you buy a property that's subject to or attempt a short sale, you want to make sure to draw up roughly the same documents. Short sales can be a lot of work before anything is begun. So oftentimes, it's best to hold title to the property, subject to before negotiating with the lender. This at least ensures that you're covered on all bases and won't lose anything in the bargain. So that is why invest in short sales, or why invest in pre-foreclosure. There's some great benefits into it, and this business is changing, and short sales are changing, especially with the whole double closings. I'm not liking where double closings are going. I think that gurus and educators that are going to continue to teach double closings, I feel like they're fast going to be non-existent, because I feel that these sellers, the lending institutions, that are discounting the mortgages, they are requiring real closings, not what we call dry closings. They're requiring payment, and that they will not accept funds from a second party. So definitely do your due diligence with short sales, but involve them in your investing strategy, and especially if you have private money or other ways that you can actually buy the property, whether it's a home equity line or something else that you can buy the property after it's shorted. That is the very best way for you to be able to make money in the current economy and with the current market conditions. So again, Colin Andrews Egbert, CEO and co-founder of realestateinvestor.com. I hope that was helpful for you. This is definitely something that I enjoy doing, and it's very important for people to be educated properly, and that they can be able to get a lot of education without having to spend $10, $15, $20, $30,000 in the process. So if you haven't been to realestateinvestor.com, you definitely want to get there, and when you do, make sure you come by and say hi to me. Look forward to speaking with you, and have a great one. Again, Colin Andrews Egbert, realestateinvestor.com. Take care.